Welcome to the Dividend Talk podcast, episode 231. Earnings season is slowly starting. What's going on, European DGI? You're recording from an airport. How crazy is that?
Yeah, definitely. Oh my God, we had so much fun, Derek. We were since Friday. We were in the Netherlands for Dividend Day. So on Friday, I was together with Ellen and Many Mystery, and on Saturday, yesterday, we had I think up to 20 people in Utrecht at the Neude. It was so awesome to see all the people. I mean, all those lads that we've been, interacting with over the last 5 years, seeing some of them for the first time in real. I mean, Rafa, for instance, that we often engage with, our moderators like Miradat, Mike Brazier, all of them were there. Neil was there, Ellen, of course, all of them. It was awesome. I mean, we spent almost the whole day talking dividends. So we started at noon, and I think I got back in the hotel just before midnight. And yeah, I wouldn't call it a vodcast, but because we didn't really drink vodka, but there was definitely a lot of Heineken, local beers, Tessels, I think, and some tequila in the end of the evening. So I think we sponsored Diageo, Heineken, and such quite well.
Oh, nice. I'm expecting extra dividends from Heineken this year. So, and then our listeners might be confused because I was supposed to be there, but I never got to make it. We had a storm. There's a lot of fun with the pronunciation of the name of the storm. I don't know who comes up with these names, but it's Storm Ewan. I don't know. It's a Welsh name anyway. But yeah, it was one of the biggest storms we've had in a long time. 2017 was the biggest one we had, but this one was bigger and better. I couldn't fly. I could not make it to the airport. All public transport is closed, and as you know, I share a car with my wife. So I had no option to take a car and park up there. And yeah, it's been a fun few days. We had quite some damage done to our house. Our roof was leaking. A few tiles fell off. Our back garden wall has fallen in. Our car is damaged. So I have a lot of dividends to spend this year on repairs, but it's all fun. Everybody's safe. Everybody's safe and sound. So that's the main thing. But unfortunately, I never got there, so I was kind of disappointed.
Well, I can speak for all of us, and that we really missed you there. Everyone was asking about you. They really want to see you there. So some of them, they will be meeting in Amsterdam again. At least that's the idea. And yeah, we were also already discussing about next year, but I'll keep that a secret for you because there's some great ideas. You'll hear that later. But yeah, no, it was just awesome. I mean, we spent a lot of time online, and it was really it was really funny. You meet each other first time, and people were hugging while saying hi because everyone knew each other also already for a long time, but just seeing each other for the first time was awesome.
Yeah.
So we miss you, Derek, but hey, you had a good reason, I think.
I was
to skip.
I was jealous, but I'll keep in contact with the guys having a meet up in Amsterdam, I believe, because it's only a short flight. And if I can make it, I will definitely try and make it across. But it was
and also respect to you because we are now recording on a Sunday evening.
Yeah,
because no way we're not going to have a podcast episode this weekend, even if it's the worst storm in 100 years. Nobody knocks you down. As long as we can talk, we will be recording each weekend.
You're sitting in an airport, which is great. I said to you, I don't know if you can hear, but the rain outside is crazy right now. I'm just concerned my roof is going to leak. I patched it up yesterday myself before we get a professional contractor. But hey, look, we will always record if we can. I mean, that's the beauty of the internet. It's the beauty of
and they were asking us if we couldn't do it in the pub yesterday. I said if I can connect with Derek, I could do it from the pub. So there's not a lot of people in the pub here, let's say, but I'm in an open space where it probably sounds like a lot of people passing by on the background. I don't know how well my mic is doing the noise cancelling, but it's a lot of travelers here.
Yeah,
I'm really in the middle.
I could hear it before you turn on the mic. It's doing a good job right now. I can't hear anyone but you. So we're doing good. So that's the news. Dividend Day in Utrecht was a big success. I mean, I'm glad everyone got to go and got to see each other. I did get a load of messages, appreciate it, and I hope to see everyone in person real soon at some point. What about dividend hikes? Surely you must have been talking about dividend hikes.
There have been a few. I know a few banks. Ellen was talking to me about it yesterday, but one that really caught my attention was the one from Signify.
Yeah,
1 cent hike. It's not a
Yeah.
lot, I think, from €1.55 to €1.56. But it shows the commitment of this company to dividend. For me, this is kind of when you think about this income factory that we've been talking a bit more later about. It's a 6% plus hike, and I think there's no other reason being in this stock than the dividend.
Yeah.
But I would really caution people. This is really such a business where you really need to know what you own, because I don't know. It's a tricky one. I mean, lighting, right? And
Yeah.
they have a large exposure to China. It's already not a business that excites me. So, the yield can really not excite me enough with this. I mean, it's a nice Dutch company, historic. Of course, it's a Philips spin-off, but I don't know what you think about such kind of businesses, because they do bring light to the world, literally.
Yeah, and Signify. I used a lot of Philips products when I was back in my electrician days. Philips was really one of the best brands, and I wouldn't say they were one of the first, but around when automation was coming in a little bit more, Philips really were kind of a pioneer in that. So I always kind of had a soft spot for Signify, but like you, I struggle to see where growth comes over the long term. It does have a high dividend yield, but that's just not enough. I think it's 6.8% at the moment.
Yeah,
With,
because we're dividend growth investors. That's something else than pure dividend investing. People make often this mistake that because of a dividend investor, you want to only buy those yield suckers that just give you dividend cuts. No, we're looking at the growth component even firstly, before the dividend.
yeah, and I mean sometimes you use this 10% yield on cost as not like a benchmark, but as a milestone for a company. But if you start with a 7% yield, say, and you're increasing 1 cent, you're not going to get to that 10% very fast. It's going to take quite a long time. So yes, I think the growth part is important, and I think it's what distinguishes us versus just an ordinary dividend investor that just is investing purely for dividends, I think. But we're going to look at some earnings this week. I think we only have 2 or 3. We're going to keep this episode shorter than normal, with respect to where you are, and it's quite difficult to record. So I'll try and take the lead on some of it, but we can't not start earnings season without talking about Johnson & Johnson. We always say they're like clockwork. I think you posted something about them on social media, but I'll go through their headlines first of all. They had 88.8 billion in sales, which is up 4.3%. That's around 57 billion in medicine, 31 in medtech. So medicine is still top dog there. And the diluted EPS was around 5.79, which is a little bit of an increase from last year as well. In terms of their medicine, oncology is obviously the big one, and that grew 19.8%, and it's about 20 billion in sales. So that's quite key. PH was also quite strong, and they had a slight decrease in infectious diseases, but overall, medicine's been led by oncology, which I would expect with some of our acquisitions that we'll talk about later. In terms of medtech, cardiovascular is the big one there, 7 billion in sales, up 22.8%. Well, it's 22.8% of their overall sales. They have been spending an awful lot on research and development. So if you look at their earnings, their net earnings was 14 billion, up from 13 billion last year. And their research and development is up to 2.5 billion. So they are putting an awful lot into this medicine and medtech business. They have to do it. I know they have to do it, but it's just something to watch overall. I think the increase in this. They're also increasing their inorganic growth, which is acquisitions. The ones that I can remember off the top of my head are Shockwave, V-Wave, and there was one recently, Intracellular, I think it's called. If I got it wrong, don't kill me. I think it was called that. But they are obviously increasing a lot more in R&D, a lot more acquisitions, which puts a lot more, I think, pressure on the company. The litigation hasn't gone away, which is always in the back of my mind. We also have this biosimilar impact of Stelara, which is going to happen in 2025. And it's funny, when I was looking through the report, or they do a presentation, I didn't get a sense of any of these highlights. It was just all revenue was up, operation was up, sales were up, cash flow was up. But you still have to remember, but Stelara is going to come under severe pressure in 2025, which is why these acquisitions have been happening over the last 18 months. So I think that's just something to be aware of. Obviously, their cash flow is quite strong. It's around 6 billion, so it's always consistent. But the questions in my mind are obviously around Stellara. There's also that economic pressure with China, which I think is going to, well, the estimate is going to cost them about 2 billion this year, 2025 alone. It could also impact on margins if they get into some sort of pricing war and in some of these medtech devices. Obviously, the litigation is still there. And there was one little sentence I saw that their Varipulse operations had to cease due to neurovascular safety events. And on a whole, that didn't seem like such a big deal because it's located geography. It's a small location, but we know that they're going to rely an awful lot on new product launches that has to be successful. When you see something like that, it doesn't give you like a sense of confidence that they're going to make up this Stellara deficit from new products. So look, for me, it was just something to be aware of. Investors could look at this as a safety concern and it could broaden out, but it was just one point that I brought up. But overall, as a whole, it's been a steady year for them, like clockwork. Everything goes up 5%, increased their dividend again, as we can see. They've changed the dividend to a competitive dividend, but in their chart, they have it as a priority, and they call out in their investor webcast that they want to continue increasing that. So changing it to competitive, we joke about it. It's something we often say is sometimes a concern, but I don't think so. It's the case on this. So
I think they had it already before in their Derek, so it's not entirely new. Yeah,
okay.
Followed it again, but it's still funny to see it. Look, it's an interesting time for this company. So they're really acquiring themselves into the future.
Yes,
and those acquisitions, of course, they all need to play out, and now we will see how good they are at that. Because what people still need to remember, Johnson & Johnson not anymore the old one. Yeah, it's a new one. It's a pure pharma company now with medtech. There's no consumer business anymore. So there's a lot of elevated risk now into it when it comes to success of the pipeline. So it comes now all down to portfolio management for this company, right? Having good partnering deals, being attractive also to buy the companies to actually do an exclusive deal with them. So it requires a lot. But I can say a AAA balance sheet brings you far.
Yes. That's what gives you the most comfort. AAA balance sheet that allows them the luxury of spending 32 billion on these acquisitions in the last 12 months. So, yeah, I think they do have a lot going from. Where I struggle is with the pipeline, understanding where the pipeline is coming from. They have made some acquisitions, but I don't know much about these companies beforehand. I see what's online, but that's only a kind of a high level overview, and everybody is more positive on them. So I think we still need to see time. See how they bed these in and how it actually helps grow the company. But yeah, I'm not as bullish as you. We often speak about Johnson & Johnson. I'm more of a bear on them. They've been dropping. I can't remember what the share price is, but they're on a lot of people's buy radar at the moment. But it's the litigation, the biosimilars for me with Stellara. It's kind of making me a little bit more hesitant. But if you just look at the top line numbers,
is there any price that you will buy it for?
Oh, price
like $1.
Of course, the dollar.
Look,
if it got around $120, I think that would probably be too hard to ignore. I've seen that phrase thrown around, but
so that's where risk and reward start to balance off for you, 120.
Yeah, I think so. But that gives them probably a 5% dividend yield at that stage.
Hey, why not? It happens sometimes, right? Historically, every company goes through its summers and winters.
Yeah. So let's hope. Let's see. But yeah, at the moment, I just see a lot of risks, and I'm balance sheet alone. I'm not as bullish as the majority of investors are out there. But let's see. I've been wrong before, and I'm happy to be wrong again.
Yeah, and I'm happy to be long still.
Yes. PG, you looked at them briefly. I think did El Cuba was.
Well, we got a question about it, from El Cuba, and also in comparison to the Unilever, and I'm waiting for the Unilever earnings, so I can't really tell you. But PG, 2% growth, bottom line, top line. Can it get any more boring? So, for me, if you really look a little bit at the numbers, there's really not so much in there. Mostly comes from price, so some impact of foreign exchange rates, but almost nothing in volume, only a little bit in the baby, feminine, and family care business. So I would say it also here, nothing exciting, nothing to write home about, but it pays dividends. Yeah, and that's unique already now at this time because many companies are suffering from decline. This company is able to hold it up at this moment in time. So 2% top and bottom line means that it's able to keep its margin flat, which I think is a success in itself already.
Yeah.
Other than that, I mean, I don't own it. I don't really pay a lot of attention to it. Definitely, I will be paying a lot of attention to Unilever.
Yeah. And how would you compare them to Unilever? I would expect a little bit more growth from Unilever.
I would expect also going forward, but it depends a lot on the plans of the CEO. But I think they have the right guy in the helm now.
Yeah. So let's see when Unilever report theirs. We might circle back, but I'm expecting more than 2% from Unilever. But PG, boring, dividend paying, it's kind of what we like. Texas Instruments is one that we speak about quite a bit on the show. And we got a question from John Christophe about this, who would like to hear our opinion on Texas Instruments earnings, because he is starting to question his thesis. And let's see why. Let's look at the numbers. So if you look at revenue for the quarter or year on year, it's been down around 2%. That trickles down to operating profit and net income, which are down double digits, and earnings per share, which is also down double digits. So sales have dropped slightly. Okay, and as a result of that, inventories have kind of increased. Cash flow from operations is quite steady. 6.3, 6.4 billion. It's been like that over the last 2 years. They generate a lot of cash, that we know. However, they are spending a lot of money on capex for these new 30 or 300 nanometer wafers. So they're spending a lot of money, and that's expected to continue through 2026. And as a result of this capex, their free cash flow cannot cover the dividends paid. So the free cash flow is around 1.5 billion, let's say. Let's round it up. Dividends is 4.8 billion in 2024, 4.5 in 2023. So you can see there's a huge outflow there. So look, they have to be funding this from somewhere. And if you go through the balance sheet and you have a look at it, you can see that they're adding to their long-term debt. So basically they're funding dividends with long-term debt. More than likely they will have to do that next year and possibly in 2026 as well. So that's where the concern is. The balance sheet is strong enough, I think, to soak this up for two or 3 years. What I don't understand is they have still been buying back shares. So they bought back nearly 1 billion in shares in 2024. I don't know why you would do that when you can't afford it. You can't afford the dividends. It's putting too much pressure on them. So I'm not sure why they would pay or why they would buy back shares to that tune. That kind of puzzled me a little bit. So I can completely understand Jean Christophe's concerns here. But again, it depends on when this thesis is set for. What is the horizon of that? Because they give an investor presentation where they talk about how much capex they're going to spend, and pretty much from 2023 to 2026, it's going to be around that 5 billion. So we know it's going to be like that for the next 2 years. We know that the cash flow is going to be around 6.5. So we're only going to have 1.5 free cash flow left over. So they're going to have to fund that through debt. After that, though, so they are 60% through their capex cycle, which is quite interesting. So if you believe that the demand for this 300 millimeter wafer is going to take off and generate this growth that they're expecting, maybe sticking out these for the long term is not such a bad idea. But I get it, in the short term, it does look like it's under a little bit of pressure. We raised these concerns maybe a year and a half ago, and to be fair to management, they've highlighted as well. So it all depends on your long-term outlook on these guys. So let's see. But look, for me as an investor, if I was new into this, I would probably wait a little bit longer. If I owned them, I would probably still hold them as well. So I have about a small position, maybe 5 or 6 shares in Texas Instruments, and I don't think I want to sell. I don't want to sell them, but I would understand if you are now looking to invest in them, I would maybe hold my horses to closer to the start of 2026 and to see how their capex spending is going to, what that's going to look like in the next 5 years. And what their growth is going to look like after that. Yeah, so I mean, I'm curious to hear your thoughts on them. I know you have a position. Are you selling because of their free cash flow woes, or are you
Oh no,
happy? Are you happy
I'm
to
not
hold on
going
to them?
anywhere. I'm not going anywhere. Like, I mean, we are talking here about one of the best management teams in the world, like historically, with a passion for free cash flow. They really tick all the boxes that you would typically look for in management. Also the philosophy. So what's not there to like? They were very clear and transparent in their investment cycle. They are not like Intel, where I kind of made the mistake of on the competition, because we're not talking here about the highest end technology like Nvidia and the race in AI. We're talking here about let's say the home garden and kitchen chips that you need to keep the world running. So, and I think they're really, I mean, it's Texas Instrument in the world effectively a lot about this, right? Specifically in the Western world. So, and they're just there, but they are just doing is like increasing capacity, upgrading, and that's what they're doing. So what you also need to think about is after 2027, you also need to again discount their cash flow a little bit, because you will need to take the reservations into consideration for the next upgrades 10 years later, or whatever happens from technological development. So what you want to see at that moment in time is that they don't just buy back shares, but that they really clean up the balance sheet. That's what you want to see. Like
Yes.
oil companies, during the cycles where the cash flow keeps raining in, you want them to get to an AAA credit rating almost, so that they can leverage up again when they have these investment cycles. And that's what you need to pay attention to with Texas. If they get the cash coming in and suddenly start not paying down the debt, but and that they have now paid for dividends and start increasing massively buybacks, then there is something wrong. I also don't understand, by the way, why they are now buying back shares, but it seems to mostly be to avoid dilution from what I've seen. Yeah.
Okay. Yeah, it's the one thing that concerned me, of course, is that, and they're slowing down in sales as well. I don't know if that's China related. I assume so. I didn't go deep enough to look into it, but obviously if sales are declining and margins are under pressure, it could
But
impact.
for me, Texas Instruments is also a little bit signaling how the industry is.
Yes.
Yeah, and we know that traditional car makers are struggling at the moment. So definitely there is something also going on there, which weakens their sales as well.
Yeah. But I stand by what I said. If I was looking at buying them right now and did not own them, I probably would wait.
Yeah, but at $200, come on. I was buying them when they were like $150 last year.
Yeah.
I mean, $200, come on. That's not a price for that. I mean, not for me.
It's so funny now. I'm looking at the 5-year trend on Yahoo Finance. That now is 2020. So you can see all these companies starting from a low base, because obviously their share price, and it goes literally up from there. But 2020 was 5 years ago. It's crazy. But look, aside from that, I understand Sean Christopher's concerns, but I think you have to take a longer term perspective with someone like Texas Instruments, and management have been crystal clear every step of the way. And I think that needs to be mentioned as well. It's not like this is a surprise for anybody. They have been crystal clear with this. So
Exactly.
okay, we move on to some listeners' questions. Nice. Centrino has asked the first question for you, and he's asking, would you consider using the strategy described in the Income Factory book? Have you read it, first of all? I know you started.
Yes, I'm 2/3 down the road. And what is interesting, you know, I already own Rio Tinto, BHP Billiton for many years, and so effectively I have income factory stocks already in my portfolio. I was just not knowing that they were called like that. I often mentioned to you, I have them for the dividends. I know that they can cut, but I see a floor in the dividends there across the cycle. So that's always been my thinking. So what I've been now doing is like categorizing a certain amount of income, like such kind of stocks that I allow in my portfolio. I know what the numbers are today, so I'm just making it more formal. And I will write a small blog post about that on europeandgi.com in somewhere in the upcoming days, because it also relates to my 2025 goals that I want to share. So and that's effectively it. And you know how it works, right? I have my dividend portfolio tracker template, and certainly you just keep adding columns behind it. So I've got a column with dividend safety rating from our premium service. So I know what my target is for safe dividends, and questionable, let's say, what I allow in my portfolio. now I have something like with dividend growth or income, yeah, or growth. So I'm just using this for slicing and dicing and looking with different views at my portfolio, and it's rather about formalizing something that I was doing already and being able to better name what it actually is, inspired by the book, than that I'm now having an eureka moment and think like, yeah, let's throw my strategy overboard and let's go fully into SEFs and business development companies and all the tankers and all the other shite. No, that's not what's happening here.
I like it. I like it. But yes, I mean, I think a balance is definitely. We talk about diversification, and usually diversification to people means diversifying in sectors or companies. But I think in strategies as well, it can be quite important to have a little bit of high yield, low yield, high growth, and so on. So it's just
But I
balance.
had it always that I want to balance off some high yields with low yields. I was even often mentioning also to you like, oh, sometimes let's say buy a share of ASML and compensate it with British American Tobacco, something
Yeah,
like that, right? And you still have a nice average yield. Then you combine like direct current income with growth. Yeah.
yeah, yeah. Dividend controller has asked, have we ever thought about giving up dividend growth investing and change strategy? We ever thought of it?
Yes. Yes.
And how did you not? How did you stick to it?
Just reminding me why I'm doing this. I mean, come on, how could you not in 2021 have at least one time a thought that you thought like, okay, let's throw my whole strategy in the bin and throw everything in ARKK from Kathy Wood, or let's buy DocuSign because wet signatures is all we need in the world. We don't need food anymore, like the Unilevers of the world supplies. The only thing we need in the world is wet signatures and rockets for space travel from Virgin Galactic. How could we not have thought that? I mean, I know, because it's, at that time, you have kids from 16 years old, 18 years old, outperforming you by a mile, and they think, like, what the fuck am I doing wrong? Yeah, so of course it came to my mind, but I always go back to my calculator, my template, think like, why would I change strategy if I know that if I continue doing this, it's kind of, let's say 6-7 years down the road, it's kind of guaranteed if I stick to my discipline because I know what I'm doing, I understand this stuff, and I know that I'm capable of continuing my savings rate, provided that I stay healthy. So why would I give that up for, in the end, speculation somehow? Yeah.
Yeah,
So
yeah.
that's what's keeping me all this. Like, why would I give it up? That's always my thinking.
You might as well go down to Vegas and roll the dice and see what comes up. If I mean, if you
Yeah,
want to
but there are people that are
change
good in
strategy,
growth investing. Yeah, there are people good in total return investing. I just always say I have a struggle with selling, so
yeah,
that's why I'm not in there.
I get that, but I think if you're good at something, you shouldn't swap and change because something else is outperforming you. If you're good at value investing,
Yeah.
stay in that lane. You don't have to
So
go
I
into
just want
Bitcoin
to. I'm just saying this to show that I think everyone has those thoughts, and people that are not having those thoughts, that
or
would
robots.
surprise me. Yeah, I think what the issue is, and we discussed it also yesterday when we were in the pub together. People are, and some people are often switching strategies. Yeah, and I think that's a problem because, like we said, and Varun was also there. He reminded me about it. That we said that like your portfolio is like a bar of soap. Yeah, please
Yeah,
don't touch it too often because it will be gone.
yeah,
Yeah.
yeah. I agree. Philippe has asked about starting a new currency snowball in his portfolio without sacrificing accumulation of assets in other currencies. So I think his portfolio is made up currently of USD, Great British Pound, and the zloty, Polish zloty. And he wants to start investing in, say, European companies, which gives him euro exposure. But the problem that he has and what's discouraging him on this is that in the beginning, he'll have this currency risk, currency exposure, but the return from it won't be that much. So he's worried that it will take away from his dollar cost average opportunities in some of his other shares. So he's kind of torn on this. What would you do in this situation?
I mean, I don't honestly, I don't see the problem, but maybe I don't understand the question well enough. I mean, if you buy a great business in a euro currency, then what's the issue? I mean, you have no influence on the euro, of course. So yeah, you have the risk that if you only buy once a euro stock and then in 10 years again that you have a currency impact. But I'm buying euro companies like let's say every month. So for me, I'm just
Yeah.
dollar cost averaging into the euro. But I'm not paying attention to that so much. If I just like the business, I buy it, and yeah, that's how I look at it. So of course I don't buy in Asian stocks and everything, so I don't care about those either. Yeah, so I'm really limited exposed to Swedish crown, Danish crown, euro, dollar, and zloty. That's kind of what I'm exposed to.
Yeah, it can be quite difficult with currencies because it can have an impact on your portfolio. You know better than me because you're living in Poland how the zloty. It's a little bit easier because euro is probably a big currency, so I only really go between that and USD. I do have small positions in Evolution, but after that, it's that. So I can understand, but honestly, I'd be like you. I wouldn't think too much about it. I would focus on buying great businesses and hoping that the currencies will even itself out over time. JVDK, what is your take on covered call ETFs? So JEPI and JEPQ are now available in Europe, listed in Ireland, so there's no dividend tax unless you're an Irish citizen. But what's your take on these?
I just know why you own them. Yeah. So what happens with these sometimes is that, first of all, they're not paying well, they're okay. They're distributing the form of dividends, but what they're really sharing is their option income. That's what they're sharing with you, right? So just know that you have a part of your portfolio exposed to option strategy, and this usually works nice while the stock market is going up. But if it goes down, you may just lose a lot of capital, which is really hard to recover from, because from there it starts to sell call options again, and you have always limited upside somehow. So just know where you own them. We haven't really experienced since COVID, when these things became popular, really a big drawdown there. So I don't know how these hold up in the recession. But for instance, if they are yielding now 10%, let's say the $10 cost, and the stock market will crash and this will go to $7, you get 10% on $7 probably. Yeah, that's what reality is. So you will lose both on capital and dividend income. That's my suspicion. But still, it is a high income place. But just know why you own them. Yeah, I think that's the most important. And I just described some of the risks that I see that I don't feel comfortable with.
Yeah, nice. Dionysus has asked, have you ever looked at Qualcomm?
Yeah, and I love the business, and it's one of those companies where I regret not having stepped into it. I remember very much the litigation they had with Apple. They kind of solved that. Also, I was reading up last year about the strategy, and there was a really good podcast about it. Is it this Acquired podcast, I think, where they did an episode on Qualcomm? I would really recommend listening to that. It was really, really good. They really dissected the entire business, and I think it's a really good play on mobile chips and everything, the efficiency that's needed, the computing power in small devices, 5G, potentially even some AI. So I really like this business. It's one that we don't speak a lot about.
No, not at all. Pedro has asked about Nike. It has a D dividend safety grade on the quantitative system on Seek and Alpha. Surely one must do their own due diligence, but does this somehow show that the common evaluation of Nike as high dividend paying stock? So basically, I think what he's saying is it's not as safe as what we think.
I don't know what the model is based on. Seeking Alpha is usually the algorithms. Sometimes algorithms should really be followed, but I don't know what the algorithm is based on, and I don't know what it gives a minus D. In my opinion, the dividend is safe because it has a nice margin from a payout ratio point of view. I also think Nike is a strong brand, so I don't see an issue there.
Okay. Richard Taylor has asked me about an investment trust. It's ticker symbol CTPE. It's a private equity fund, and he's asking if I have ever looked at it. And the answer is it is on my watch list, but I haven't dug into it enough. And he's right. So it has got some impressive numbers. It's got around 5.7 dividend yield. Its 5-year dividend growth is 14.26% over the last 5 years, which is quite impressive. Their dividend policy is to pay not less than 4% of the average of the published net asset value per ordinary share at the end of the last 4 quarters. So it pays 4% of its net asset values. And it also gives you access to funds and equity that probably retail investors would not access to. So 100% it is on my radar. It's also a dividend hero, which basically is 25 years consistent dividend growth for investment trusts. And yeah, it's one I'll be looking at keenly. So I might add this to the top of my list, Richard, and be curious to ping you and get your thoughts as well, see if we align. But it's it's one at the forefront of mine. I mean, it's hard to ignore a double-digit 5-year dividend hike with a high dividend yield as well. So yeah, of course, it's on my list. Let's see. Tim Ainley has asked, which do you think is the highest quality insurance company in Europe?
I think Munich Re, probably followed by ASR and Allianz.
I was thinking you'd put Allianz top of that list.
No, Allianz has also a lot of asset management. So for me, Munich Re, the reinsurance business is of higher quality, more stability.
And that is the last question. So we have got some other questions from Darshan, Eric, Hans, and Anders, and they're all company specific. And given you're sitting in the middle of an airport, we didn't really have too much time to prepare. So what we've done is we've copied them into next week's episode. So they're there in the notes, so we won't forget about them. But there was one also, not a question, but a suggestion from Cyril. And there's a Dutch podcast called Bears Talk. Maybe you might know this. But on this, there's a CEO of Yannick Europe, and he's regularly on there talking about ETFs. So it might be good to have him on and talk about ETFs and maybe the potential of a good European dividend growth ETF. So
let's do it. Let's reach out to him.
Yeah. And let's do it. Let's see if we can get him on. So that's it. No more questions. Thank you so much, European DGI. You took the time out while you're busy traveling to record this. And to all our listeners, we appreciate all the questions. Thank you for listening so far. Don't forget to like us on Facebook, rate us on Spotify, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.